want to talk about is how to build a family bank. It all comes back to some of this stuff that you may or may not have seen in previous videos on this channel. Coming back to cash value whole life insurance and, utilizing infinite banking and things of that nature, there's ways where you can build up this cash value that grows. And if you watched a couple of videos ago, I showed you one of my old policies, and it's a smaller one, but it yields a good amount of cash for what I pay in year after year, and it just keeps growing and growing and growing, and you get more money and more money and more money. But anyway, you get your money back, and then you get money above and beyond that, and it continues to grow each and every year. That amount goes up. But anyway, the idea is that whenever you build these family banks, you can set things up. This is like a legacy planning thing, more of a estate planning. You can have several policies on all your family members. So it can be policies that are on you, on your wife or spouse, significant other, your children. If you have children, you can do them on grandchildren. You can do them on other family members in some cases. If there's a beneficial, or not a beneficial, if there's an interest, that actually makes sense, right? So if you were putting money towards, if you were to take a life insurance policy out on a parent based on need, for example, maybe so whenever they're older, you're taking this out, you're contributing to this policy, you own the policy, and it's in the thought process that money will be needed to pay for maybe long-term care or something else. There's multiple reasons you could utilize that. And then whenever your parent passes away, you're basically getting the money back, or it's paying off the loans that you would have taken against the policy. So there's a number of things, but it's a way for the money to grow. It's a way for, another way to utilize it. So whenever I say this, you're able to utilize these things, but without getting too far in the weeds on that. Let's just say you have 3 kids and it's you and a significant other. You have policies on, maybe over time you've gotten a couple on each kid, and maybe you have 2 to 4 on each parent. I'm just giving possible real world scenarios because I've personally done this. And so then you can actually set up, you can go through an estate planning attorney, which we work with estate planning attorneys all the time. We have a couple on our team that we work with to help for legacy planning, especially for pretty much any individual, but I would get a number of high net worth individuals as well, that they want to make sure that money gets passed on without, one, with privacy, and 2, without a bunch of additional need for taxation, hopefully, so they don't have that estate tax, because you might get death benefit income tax free, but it may be subject, depending on your state, to estate taxes. So it depends on the size of the estate. It depends on a lot of different factors, but utilizing an estate planning attorney is key. But in a lot of cases, they can set up a trust. They can make the trust own and make the trust the beneficiary of the life insurance. The money's accessible through loans still. It's not considered income. Whenever the death benefit comes in, it's tax-free. And then you can set up to where there's the bylaws and whatnot, and all the instructions that were left are that all this money goes to buying additional life insurance policies on the heirs that are going to be beneficiary to the trust itself. And so this creates the generational wealth, because as time goes on, these things are paying into the trust, then the money is going into these policies, and the policies keep you from having to pay a bunch of taxes, because the trust is taxable at the highest tax bracket, starting from about like $13,000, I believe. So it's low. But if your income that you're generating is tax free, then you don't necessarily have those worries. And an estate planning attorney can go further into this. There's other ways of accessing the money with lines of credit and whatnot, which can make it even easier to an extent, that are utilizing the policies as collateral. There's so many there's so many options, but you can take that a step further, because you can do planning with this. You can have meetings, 2, 3, 4 times a year, whatever it is, or maybe you just do twice a year. You do these meetings, you make it a vacation destination kind of thing. You get the whole family together and you discuss the planning with it. And then, of course, ideally you get a write-off for it. That's going to be up to your CPA or your tax attorney, but on how that's handled. But there's rules for that, I believe, and stuff like that. I won't go into that because I'm not a tax attorney or a CPA, but I can only give you either my experience or the knowledge I have, food for thought, more educational purposes. So please don't take this as financial advice. But like there again, I can always comment on my experiences and what I've seen with my clients and whatnot, of things that they do. So anyway, for estate planning purposes, it's a great tool. There's a lot of wealthy families over the years that have utilized this, like let's just say Warren Buffett owns a whole bunch of it. Of course, he also owns a number of insurance companies on top of that. And then beyond that, you have like your Rothschilds and, a number of other families that, the Rockefellers, stuff like that utilized these policies in order to pass down wealth. And of course, the growth within the policies and so forth. And there's ways of even stretching those policies out on growth, because if you have a significant other and you're married, you can do a joint survivor policy, which in a lot of cases will reduce the cost of insurance, but can increase growth, because not only is the insurance a little cheaper because it's on 2 lives and they know it's going to continue above and beyond. There are some limitations, but you can have that modeled and see what that looks like. And if it doesn't happen till the second one passes, and the second spouse may or may not outlive significantly. I have grandparents that one of my grandparents was in his mid 80s when he passed. And that was many years ago, because he was a fair amount older than my grandmother. But my grandmother now is 98, about to be 99. And he was already like 10 years older than her. So she's outlived him by 20 years. If they had had this situation, she would have benefited hugely. And so would her immediate children and grandchildren and whatnot would have benefited from it. But a lot of people don't know about this stuff. And that's the unfortunate part. And that's why, in a world of, social media and YouTube and all this other stuff, it's good that you can learn about these things. So I try to put the word out. I know that there's others out there putting the word out. Whether it's the same message or not, that's a whole different story. But most of them are emphasizing the need for, life insurance in some capacity, and whether it has to do with legacy planning, whether it has to do with, in some cases, it might just be to cover funeral expenses or whatever, so that burden's not on the actual family itself. There is an entire segment of life insurance that's just for what's called final expense. And people are buying this because they're barely insurable, and it's so expensive at the age that they're finally getting life insurance. Whether they had term this whole time or not is a whole different story. They probably didn't. That's part of the reason why this even exists. But you're basically buying this insurance, let's say $25,000 or $50,000, just to cover literally your final expenses, your any cost related to burial, any cost related to any outstanding bills or anything that maybe burdens on your family members. And there's nothing wrong with that. But if you have the ability to get in at a younger age, say at 30 or 40, or maybe you're in your 20s and you're not even married yet, if you have the ability to get in, get cheap insurance, cost of insurance, and grow the cash value significantly, why not? I started this with my kids from the time that they were 2 weeks old. Their cash value and their policies is going to be amazing whenever they're that age to even, let's just say, retire or anything else. So I am glad that I was glad that I was introduced to this, because even before I was introduced to it, I didn't think anything of life insurance. Not to mention I wasn't married yet, so I didn't even think about it. And then whenever I did meet my wife and stuff like that, I started thinking about it more, because I already had some, and then I added some on myself, and I added some on my wife, and she was, she had gotten pregnant, and so, we'd been planning for a child and all of that. And then whenever the child was born, we took out a policy on him 2 weeks later. So it's part of our planning. And one of the biggest reasons why is just for the simple fact that it's beneficial in many ways. And there's other benefits to a lot of these life insurance policies. If you have a chronic or terminal illness, you can actually, depending on the insurance company, you can get anywhere from, say, 50% all the way up to 100%. It depends on the insurance company there again, and how they're set up with their living benefits. But you can access up to 50, or let's just say 90, 80%, 50 to 80%, let's just say in general, of the actual death benefit. So maybe you have $1 million policy, but you only have $300,000 in cash value. Well, you can actually access, if it's 80%, say up to $800,000. I mean, that's huge. And if you're in a situation where you have cancer or you have some sort of illness that would qualify, that can help pay your bills. That can help pay any out-of-pocket medical bills. That can pay for a number of things. I mean, that's just one of the other things, in addition to the death benefit when you pass, in addition to the cash value while you're alive. And then there's additional things you can do, options you can do with those things. It changes the policy a little bit, or the uses of the policy. Or if you use it for one thing, you can't use it for another in some cases. But nonetheless, it covers a lot of bases that you wouldn't cover otherwise with life insurance. If you just have a term policy, you're not going to have cash value. So it's anything you pay is just going out the window. And you can say, oh, well, you can get a return of premium policy. Well, that's more expensive, one. And two, they're hanging on to your money and then for all this time, and then they're not paying you anything in return for hanging on to your money. There's no interest, there's no dividends, there's no nothing. So, there's a whole argument, believe it or not, amongst the actual profession, or life insurance, as opposed to maybe somebody who's strictly focused on financial planning and they want to put the money into mutual funds, or, a retirement plan and then into a mutual fund. It's the thing that I don't understand is it's not necessarily you have to do all in on one or the other. You can have both, or you can have whatever. Or you can, there again, you can put your money into the life insurance, and then you can take it, borrow against it, and put it into whatever other opportunity There may be. So to be just one-sided about it, I've never understood that, but you know, some people just feel that way. So anyway, please like, subscribe, click the notification bell. If there's anything you would like to hear about, any topics, any questions you have about any of these videos, please put the question in the comments down below. I will do my best to put out some content on it. Thanks and have a great day.